Everyone thinks they need a better investment. They don't. They need a better order. Right now, somewhere, someone is buying a hot stock while carrying the 24% credit card balance. Someone else is putting money into crypto with no emergency savings. Another person is maxing out investments but ignoring free employer match. It feels productive, it looks smart, it's financially upside down. And this is why two people with the same salary can end up in completely different realities 20 years from now. Not because one was smarter, because one followed the correct sequence. Let me show you the smartest order to invest your money, step by step. No hype, just mechanics. First, eliminate high-interest debt. Not your mortgage, not low-rate student loans, high-interest debt. Credit cards, personal loans, anything above roughly 8 to 10%. Here's the math nobody argues with. If your credit card charges 20% interest, paying it off is a guaranteed 20% return. Guaranteed. No volatility, no bad year, no crash. You will not find a safe investment that beats that consistently. Yet people invest at 7 or 8% while bleeding 20% on the other side. That's not investing. That's digging two holes at once. Before you grow money, you stop the leak. Second, build an emergency fund. 3 to 6 months of essential expenses in cash, boring cash. This feels inefficient. Cash doesn't grow much, inflation eats at it. But this fund does something more important than grow. It protects. If you lose your job or your car dies or the economy hits a rough patch, you don't sell investments at the worst possible time. Think about every market crash. The people who panic sell usually don't want to. They have to. An emergency fund separates inconvenience from catastrophe. It turns chaos into patience. Third, capture your employer match. If your company offers a retirement match and you're not taking it, you are declining part of your paycheck. If they match 100% up to 5% of your salary, that's an instant 100% return on that contribution. You put in $5,000, they add $5,000. There is no stock, no real estate deal, no trading strategy that gives you a cleaner return than that. And yet millions leave it on the table because it's not exciting. We prefer chasing 30% upside over locking in 100% immediately. Strange. Fourth, maximize tax-advantaged investing. Retirement accounts, broad index funds, diversified exposure to the market. Simple. Historically, broad markets have returned around 7 to 10% annually over long periods. Not every year. Some years are ugly. But over decades, businesses grow and economies expand. The key advantage here isn't just returns, it's taxes. When your investments grow without being taxed every year, compounding accelerates quietly in the background. Over 30 or 40 years, that difference can mean hundreds of thousands of dollars. Not because you picked a genius stock, because you reduced friction. Now and only now we get to taxable investing and higher risk opportunities. Brokerage accounts, real estate, side businesses, even speculative bets. But notice what just happened. By the time you reach this step, your financial life is stable. No high-interest debt dragging you down, cash buffer protecting you, free employer money compounding, tax-efficient growth working in the background. Now you can take risk without risking everything. Here's the uncomfortable truth. Most people start at the last step. They jump straight to stock tips, crypto, options, day trading, because it feels like progress. But investing is not about excitement, it's about sequence. The order matters more than the asset, especially right now. Interest rates are higher than they were for years. That makes debt more dangerous. Markets are volatile. That makes emergency funds more valuable. Job security isn't guaranteed. That makes stability priceless. In uncertain environments, defensive positioning isn't boring. It's strategic. And here's the irony. The smartest financial plan will feel slow at first. You won't feel rich paying off debt. You won't feel powerful building cash reserves. You won't impress anyone by consistently investing in index funds. But 5, 10, 15 years from now,
The person who followed this order will have something most people don't. Options. The option to change jobs. The option to invest more aggressively. The option to withstand a downturn without panic. Wealth isn't built by chasing every opportunity. It's built by removing the ways your plan can fail. So, before you ask, what should I invest in? Ask a more important question. Is my financial foundation strong enough to survive being wrong? Because eventually you will be. And the smartest investors aren't the ones who never make mistakes. They're the ones who structured their money in the right order so mistakes don't destroy them.